Now let me guess, you have been told something like the 2022 model is all you need to trade, which is true, but I'm also going to guess you still don't make money from trading. Why? Because you don't understand which fair value gaps to actually use. After today's video, you will have the criteria and a little trick at the end to determine whether the fair value gap you are looking to use is actually going to hold. So, diving straight into the video, what I want to discuss today is which fair value gaps we actually want to use. Now, the 2022 model that you've all seen on YouTube by ICT or the Inner Circle Trader is a great model, and you will make money using this model if used correctly. Now, the downfall of the model, I think, is that you will get wicked out a lot. And if you don't know the dynamics behind fair value gaps and the reasoning behind certain fair value gaps holding and certain fair value gaps not holding, then you will struggle to make money with this model. So today we are going to cover all of that. There are certain criteria, as I mentioned in the intro, to a fair value gap that make it high probability. Now I can list those criteria now for you, so listen up. The first thing is the fair value gap needs to be birthed inside of a sell side or a buy side liquidity pool. What do I mean by this? Well, if you take a look over here, we have this fair value gap, which if I make a grey box, you can all see very clearly. We have this fair value gap, and you can see this held, and we ran out sell side liquidity. Now, why did this fair value gap actually hold and not one over here, for example? Why did that not get traded to? Well, this fair value gap in particular was incorporating different things. The first thing it actually incorporated was this dominant price swing and it being in a premium of the dominant price swing. So we are in a premium, which ticks one box. We have a weekly direction of downwards because our bias is bearish because we're in a premium and we've traded and rejected from that premium. Okay, and now what do I mean by birthed inside of a buy side liquidity pool? Well, if you take your attention to this high, if we look to the right, we have another high. And if we look to the right again, we have another high. That's three highs. And what rests above highs is buy side liquidity. So this we will label our buy side liquidity pool. So this is our buy side liquidity because remember, we have three clean highs that all coincide with each other. Okay, so when we reject from down here, and we break lower with speed, which is the second piece of criteria. Speed and distance, okay? So look at the velocity of this move here, the one that creates the actual fair value gap. This comes down really quickly compared to certain fair value gaps which are made lethargically, like this one over here. If we look inside here, you can see this is a really small fair value gap. Now, why wasn't this traded to? Because look at how it is made. One drop down, two drop down, we start to lag around. Okay? Do you see how choppy it is after the fair value gap's made and how small it is? Whereas when we drop from here, that candle drops, the next candle drops, and then we get a huge candle here. Do you see? Now, this is quite discretionary, don't get me wrong. The approach to the 2022 model is discretionary by nature. So this speed and velocity is enough to tell me this fair value gap that's forming is going to hold. Now I must say, I don't care what this candle closes like. This candle could close down here or it could close up here like it did indecisively. This gets traded to anyway. We begin to consolidate and then we drop down and take out sell side liquidity. So I've given you two little criterias there to make sure the fair value gaps you're using are actually going to hold. Remember what it was. It has to be birthed inside a liquidity pool, and we need to have speed and distance when creating a fair value gap. Now, I have one more thing and one last piece of criteria that make your fair value gaps even more high probability, and that is if they are coupled with an order block. Okay, so if we zoom in here, you can see Now, first of all, actually, let's define what an order block is. An order block is a succession of down closed or up closed candles which confirm the change in the state of delivery. So this, you can see before this drop down, these 4 up close candles are formed, and then we drop down with that speed and distance we're looking for. Now, these 4 candles are birthed inside the buy side liquidity pool as well. Once we drop and then close below it, right? That's the key here. We need to close below the bodies of the 4 up close candles. Now, this can be as many up close candles as it needs to be. This could be 1, this could be 2, 3 or 4 or 5. It doesn't matter. In this case, these are the 4 up close candles before we drop down. So this becomes our order block. This fair value gap that forms with the displacement is forming inside of our order block, which makes it even more high probability. That is why this one got wicked into. We began to consolidate, which doesn't matter. Remember, we can sit through consolidations because your stop loss would be above this high. Why would it be above this high? Because this is the high that's protected because we ran out buy side liquidity in these, this and this over here. And we expect a short-term high to fill the fair value gap, which makes this high an intermediate term high. This shouldn't be broken, therefore, and your stop loss goes above that. If that level is broken, your trade is invalid. Your stop loss should always be at a level of invalidation. So we have an order block, drop down, trade into it, and then trade away and take out this original consolidation and fully fill the fair value gap down here. This is the key in fair value gaps. Look where price reverses from, okay? We take here, look where we trade into. The bottom of this bullish fair value gap. Now, what do you notice about this bullish fair value gap? Well, I notice the fact that if we zoom in, you can see we have a swing low form because we have a higher low and a higher low. This is a swing low, but then what happens here? This swing low gets raided, okay? So this low takes out this low, which means if we move up now, we have a valid order block. We have a valid order block in this down close candle because it was birthed inside this sell side liquidity pool. And then we move up with how much speed and distance, right? That is a huge candle. And that's the exact sort of thing we're looking for, okay? 120 points, that candle is. And then you can see, where do we target? If you're in a sell from here, okay? Let's say we're in a sell and we took this fair value gap sell. Stop loss there, where would we target? A nice 1 to 1.5 seems viable. You don't have to go for 1 to 1 to 6s, all the time. This would be our exit. Why would this be our take profit? Because of all the criteria I just outlined. We have also sell side liquidity. We have a low just above the bottom of this fair value gap. So sell side liquidity rests below here. When we're in a sell from up here, that is where our take profit can be because of all the logic I just outlined. Okay, remember the fair value gaps we want to use for entries and exits always have taken some liquidity and have an order block and have speed and distance when creating them, okay? That is what I want you to remember when looking for fair value gaps. Now, if I outline another example here, okay? Let's zoom into this bit of price action, okay? Remember, we have a different range now. We're trading from a different range. We have this low and this high. So if we are bearish, let's say on a monthly, let's use our range. So we have a premium and a discount. And let's extend it out this way so it's a bit clearer. Okay? Now, what happens inside here? Well, we have an indecisive candle. Remember, we've ran above buy side liquidity now. We drop down. Where do you see a fair value gap in here? I see it right here. And what does it overlap with? You can see this fair value gap actually overlaps with another fair value gap on the other side. Now we have a balanced price range. When we have a balanced price range like this, we can anticipate price to wick in, and then run away quickly, like it does here, twice. We run away and then we start reaching for sell side liquidity. At this point, the algorithm is telling us to reach for sell side liquidity. The algorithm wants to take sell stops out of the market. What else do you see? A big up close candle before the drop, and we close below it. Okay, so what is this that I just outlined? This, once closed below, becomes your order block. All of these are your order block because it's birthed inside this buy side liquidity pool right here. Okay, so we trade below, wick into it, and run away. We keep running away. In here, do you see any obvious fair value gaps that create displacement? I don't. Okay, so don't worry about it. You might not have got in. You probably didn't get in, and that's fine. We trade lower, and then we break this sell side liquidity. 3 lows, 3 drives. There's a lot of sell side liquidity to be absorbed down there. When it does get all absorbed, we can anticipate a retracement. Okay, we retrace. Now, some of you may look at this as a fair value gap you want to see buys from because it was birthed inside a liquidity pool, right? And it got a strong move up and created a fair value gap, right? Wrong, because remember, we always refer back to our higher time frame buyers, and the weekly and the monthly chart were indicating we want to go lower for this sell side liquidity. So we ignore that, and you can see it gets cut through. It gets traded through very quickly, okay? Now, what else do we see here? Well, we see an order block form above buy side liquidity. But once we're down here, we get a wick into that order block, okay? So there's one sell. Because we closed below the order block, we get a wick into the top candle, move away. If you're waiting for a fair value gap, wait for this low to be broken. You can see this low gets traded below. Remember, speed and distance. Do you see how far we go and how quickly we do it? When we start to print indecisive candles down here, look to your fair value gaps. Some of you may be waiting for this one. But I would suggest to you, look for this one to hold. Look for this one to hold. And if it returns into the higher fair value gap, that's fine. Leave room for it to. Okay? So let's just say you were selling that. Leave room for it to return into the fair value gap. So keep your stop above this just in case it wants to come up here, and then aim for the sell side liquidity on a 1 to 2. Do you see what I'm doing here? Take the nearest fair value gap and allow room for it. Allow breathing room. If it does need to come and mitigate this, you're protected by a stop loss. Your stop loss is above this gap and this gap, okay? And that is what I wanted to outline to you about fair value gaps. Now remember our criteria before we finish it. Birthed inside a liquidity pool, created with speed and distance, and then has a order block with it, okay? Apply these to your selection of fair value gaps, and you will see your trading improve instantly. With that being said, that brings us to the end of the video. If you did enjoy this video, please do drop a like and a comment. Check out my social media in the description below, and please do reach out to me if you have any further questions. Thank you for listening as always, and thank you for watching. I will catch you all in the next video.